NIO stock slipped back into the red on Tuesday, giving up most of Monday's gains and reminding investors that volatility remains the name of the game. The stock closed the session down 26 cents, or about 3.7%, finishing at $6.80 per share. After briefly reclaiming the $7 mark on Monday, today's reversal served as a reality check, a reminder that confidence in the market remains fragile and that buyers and sellers are still locked in a tug-of-war over NIO's short-term direction. Let's unpack what happened today, what may have driven the weakness, and what investors should keep in mind as we move into the midweek session. To begin with, there wasn't a clear new headline or news release that directly triggered today's decline. The story remains largely the same as it has been for the past week: the ongoing fallout from the GIC lawsuit, lingering questions about accounting practices, and a market that's trying to decide whether the recent bounce was sustainable or simply a short-lived relief rally. On Monday, NIO rallied more than 4% to close just above $7, driven mainly by dip buying and technical support near the mid-$6 range. But as traders returned to the screens on Tuesday, enthusiasm appeared to fade. Without a fresh catalyst to sustain momentum, profit-taking set in. The stock struggled to hold above that $7 threshold and gradually lost steam through the day. This kind of pattern, a sharp bounce followed by a moderate pullback, is not uncommon in volatile names like NIO. Often, the first rebound after a steep sell-off attracts short-term traders looking to capitalize on quick gains. Once those traders exit, the stock tends to retrace a portion of the move before finding its true equilibrium. That's likely what we saw today. But there's also a psychological element at play here. The lawsuit filed by Singapore's Sovereign Wealth Fund, GIC, continues to cast a long shadow. Even though there were no new developments today, the fact that such a reputable institutional investor has taken legal action keeps investors cautious. The case alleges that NIO inflated its revenues through its battery asset company, Waneng, effectively recording sales prematurely. NIO has denied the accusations and stated that it will defend itself vigorously, but the overhang won't lift until there's more clarity from the courts. For many investors, the concern isn't just the lawsuit itself but what it represents, a potential credibility issue. Chinese companies have faced increased scrutiny from Western regulators in recent years, and any hint of accounting irregularities tends to trigger outsized reactions in the market. So even in the absence of fresh news, the mere presence of the legal uncertainty weighs on sentiment. Adding to that, broader macro factors aren't exactly helping. Trade tensions between the United States and China remain a background risk, and even though rhetoric has cooled slightly in recent days, the uncertainty is far from resolved. Whenever geopolitical friction flares up, Chinese-listed stocks like NIO often take the hit first. On top of that, the Chinese electric vehicle sector as a whole has been under pressure. Competition among domestic automakers is fierce, pricing wars continue, and investors remain cautious after months of choppy performance across the space. Peer companies like XPeng and Li Auto have also seen their share prices fluctuate this week, reflecting the same risk-off mood. From a technical standpoint, today's move looks like a simple retracement. Monday's rally brought NIO back above its $7 resistance level, but the stock failed to hold that ground. The $7 zone has proven to be a psychological ceiling over the past 2 weeks, with sellers consistently stepping in whenever prices approach that mark. The pullback to $6.80 puts NIO right back in its familiar trading range, between roughly $6.60 on the downside and $7.50 on the upside. For short-term traders, that range remains key. If NIO can hold the $6.60 to $6.80 support area, it may signal that the stock is forming a base. If that floor gives way, however, the next downside level could be closer to $6.20. Conversely, a breakout above $7.50 would suggest renewed momentum and could open the door for a push toward $8 in the coming weeks. In today's session, volume was moderate, not high enough to suggest panic selling, but also not low enough to indicate complacency. That middle ground reinforces the view that traders are still uncertain about where NIO is heading next. There's no clear conviction yet, and until we see a decisive move in either direction, sideways volatility is likely to continue. Looking beyond the day-to-day fluctuations, NIO's fundamental story remains intact, at least for now. The company continues to post strong delivery numbers, with third-quarter deliveries up 41% year-over-year. Its battery swap network continues to expand, setting records for daily service during China's recent Golden Week. These operational wins highlight the difference between the company's business performance and its stock performance. While the market may be focused on legal and macro risks, NIO continues to execute on its long-term strategy, expanding its infrastructure, improving production efficiency, and maintaining a strong brand presence in the premium EV market. Those fundamentals don't disappear because of short-term volatility. However, until the legal issue is resolved, those strengths may remain overshadowed. So, what's really happening here is a battle between short-term fear and long-term conviction. Monday's bounce reflected optimism that perhaps the worst was over. Tuesday's decline reminded everyone that uncertainty still dominates. The result is a stalemate, neither bulls nor bears fully in control, both waiting for more information before committing to a direction. For long-term investors, this period can be frustrating, but it can also present opportunity. Historically, NIO has experienced sharp pullbacks followed by equally sharp recoveries once sentiment turns. The company's loyal retail base, strong branding, and expanding product lineup all contribute to its resilience. If the lawsuit proves to be less damaging than feared, NIO could quickly regain lost ground. But for that to happen, investors need reassurance. Communication from management will be crucial in the coming weeks. Even if the company cannot comment directly on legal proceedings, updates on operations, partnerships, and financial performance could help restore confidence. Markets crave clarity, and in the absence of it, volatility thrives. As of now, there's no indication of panic. The decline today was measured, not disorderly. It looked more like a market catching its breath after a strong rally than a fresh wave of fear. That's a small but meaningful distinction. When panic selling fades and price action becomes more controlled, it often sets the stage for stabilization. The question for traders now is whether this was just a one-day dip or the start of another leg lower. The answer will depend on follow-through in the next session. If NIO can bounce back above $7 on solid volume, it would suggest that buyers are still active and that Monday's rally wasn't a fluke. If not, we may see the stock continue to consolidate near current levels while investors wait for new information. In practical terms, the setup heading into Wednesday is straightforward. Watch support near 660 to 670. If that holds, short-term traders might look for another rebound attempt. If it breaks, expect increased volatility as stop losses trigger. Resistance remains at $7, then $7.50. A sustained close above those levels would shift the short-term outlook to positive. Beyond the charts, the broader narrative remains one of contrast, between risk and resilience, uncertainty and progress. NIO's long-term prospects depend less on short-term market moves and more on its ability to maintain growth and credibility. For now, the stock is caught between those two forces. Today's session underscored that reality. After a strong Monday, optimism gave way to caution. No major news, no big surprises, just a quiet reminder that sentiment can shift quickly in this market. Investors appear to be waiting for clarity, not rushing for the exits, which suggests the market may be entering a period of consolidation rather than free fall. In short, Tuesday's decline wasn't about new bad news, it was about fading momentum. Without a fresh catalyst to sustain Monday's rally, the stock simply ran out of steam. But that doesn't mean the story is broken. It just means the next big move will require a new reason to believe. As the week continues, keep an eye on three things. First, any developments in the GIC lawsuit, even procedural updates could sway sentiment. Second, broader market tone. If risk appetite improves globally, NIO could benefit alongside other EV and tech names. And third, technical confirmation, whether the stock can hold its range and attract new buying interest near current levels. NIO remains one of the most actively traded and closely watched EV stocks in the world. With its growing infrastructure and loyal investor base, the company has weathered setbacks before. Whether it can do so again will depend not on headlines, but on consistency, both in performance and communication. For now, Tuesday's pullback feels more like a pause than a collapse. The bulls aren't in control, but the bears aren't winning either. It's a balancing act, and NIO's next few sessions will determine which way the scale tips. And that's your Tuesday aftermarket update on NIO.